Hello, everyone. Welcome to the Kingdom Finance Show. I'm Chad Frantzen, and I am so glad you're here for this week's program. Today, we're going to talk about what are the implications of the Federal Reserve lowering interest rates this past week, and also what that means for you and I as investors looking to make wise decisions in a world that is full of chaos. So let's get ready. Let's get started. Grab a pen and paper to take notes. We're going to dive into the economy, what's going on with the Federal Reserve, and talk more as a follow-up from last week's show about what we can be doing as investors to align our money in the proper ways in the market. Let's get started. Hey, as many of you know, this past week, the Federal Reserve did, as anticipated, and as we had talked about on this show in previous weeks, they did lower the federal interest rate by 1/4 of a percentage point, also known as 25 basis points, which is just 1/4 of a point. That was widely expected, and Jerome Powell and his group of Federal Reserve Bank Board of Governors had a pretty heated conversation based on the notes that came out of this past week. There's no less than 9 Board of Governors who see very different from Chairman Powell and some of the other governors. 9 of those actually wanted to see a 50 basis points or a 1/2 of a percentage point rate cut. So we're going to talk a little bit more about that. Again, our goal for today's show is let's unpack what the rate cut means now and going forward, not only for the economy, but also for you and I as investors of our financial resources. Now, the Federal Reserve first reduced rates in December of 2024 after holding them at pretty high levels for quite some time. And we now have seen the first rate cut this year for 2025. One of the interesting things about this rate cut, not only are there a number of Board of Governors who voted against the consensus, which means there is some pretty heated conversations going on at the Fed. It certainly clears the way for 1, if not 2 more interest rate cuts in October and December of this year. Our thesis as investors is this is the first of 3 cuts that we're going to see between now and the end of calendar year 2025. Now, secondarily, this is the 3rd time in recent memory in the last 30, 40 years that we have seen the Federal Reserve cutting interest rates at the same time that the stock market is at or near its all-time highs. And you might say, well, Chad, what does that mean exactly? Typically the Fed, as we look back on history, the Fed is cutting rate, during financial crisis, economic slowdowns, things of that nature. It's typically not when the stock market is at or near its all-time highs. Well, 2 times this has happened before now. It happened last year in 2024, of course, when the Fed raised rates and the markets were at then near all-time highs. They've now since gone higher to even newer all-time highs. And also back in 1996 when the stock market at that time was at or near all-time highs. Now, both those times, the subsequent 12 months after the Fed cut rates and the stock market was at the same time at or near all-time highs, those two times the stock market proceeded to appreciate another 14% or so. And that we're basing on historical data from the S&P 500 index. Of course, past performance, not indicative of future results. Not here to give you specific investment advice on the show, but history can give us a gauge for how levers work, how the capital markets may impact us as investors, as business owners and entrepreneurs in the future. Now, all that being said, Chairman Powell has said he's focused on containing inflation and unemployment. Now, we talked about this on last week's show, is that we actually have higher than preferred inflation according to the Fed. The Fed has said they would prefer a 2% inflation mark. And that is kind of like driving out of your rearview mirror. It's a backwards indicator of what's happened in the past. Now, inflation right now at this recording is around 2.9 to 3%. We actually think that inflation is going to tick up a little higher between now and the first of 2026. And at the same time, the U.S. economy, as it's measured, there's a couple of measurements. It's called GDP or GNP, not to go too deep into that, but there's a couple ways to measure how much is the U.S. economy growing. Now, this impacts you and I because 2/3 of the U.S. economy is consumer spending. So what you and I are spending at retail stores, at restaurants, buying new vehicles, buying equipment for our companies, things of that nature. So that's a big driver in the economy. Now, one of the things that the Fed has said is they are going to have to balance what's becoming, and we talked about this on the last show, is a weakening job market. So the economy has been growing at a positive clip. It's been around that 2.5%, 3% per year growth. However, the rate of change or the rate of growth has decreased. It's still going up. It's still in the positive, still green. It's not negative, which would be, if you had multiple quarters of that, you might be looking at something like a recession. However, so the economy is still growing, but the rate of change, the rate of growth is going down a little bit. Now, when that happens, when we have growth slowing and we have inflation rising, we have what they call in the world of economics stagflation. So stagflation means just that. There's stagnant growth in the economy. It's still positive, but it's declining, and inflation is actually ticking upward on that. So different ways to interpret that, but those are two big drivers of the U.S. economy. So as investors, what that means, just to give you some clarity on this, it means there's certain asset classes as an investor wanting to be a good, wise financial steward. There's certain asset classes that you want to look at, potentially invest in, depending on your profile, suitability, et cetera, when we are in what we call a stagflation environment. I do think, based on the research groups we follow and greatly respect, I think that, as we move into the fourth quarter, the end of this year, again, we're recording this in September of 2025, we will see growth tick back up, and which will kind of move us out of stagflation as we move into the first quarter of 2026. So there are still some headwinds in the economy, and I want to explain that, and I'll get to this here in a little bit, on some of the asset classes that historically do well, that a lot of institutional investors are moving money into, keeping money invested in light of where we are with what we call monetary policy in the United States. Now, one of the interesting points that I thought came out of this is we often talk about, how does the Federal Reserve's interest rate policy, how does it affect all the other parts of the capital market system, whether that's real estate, whether that's Bitcoin, whether that's the price of gold, whether it's the bond market, stock market, all that, right? How much you can get a mortgage rate for, a car loan for. There is what is called the 10-year U.S. Treasury bond, and it's often referred to as the risk-free rate of return. It's most recently been around between 4 and 4.4%. And so what that means for us is, and many banks look at this rate, many lenders, investors look at this rate. What it tells us is that if you invested your money, gave your money to the U.S. Government for 10 years, they would in turn guarantee to pay you back whatever that rate is, for 4.1, 4.4, 4.5, you get the drift on that. Now, oftentimes that 10-year Treasury bond is a really good harbinger for several things: where the stock market is going, the health of the overall U.S. economy, and indirectly, what may be happening in the world of mortgage rates specifically. Now, it's not a direct correlation. Mortgage rates have actually been coming down in anticipation of this interest rate decrease. In fact, we've seen, even this week of this recording, the average 30-year mortgage nationally in the U.S., the Fannie Freddie mortgage rate, somewhere around 6.25%. on that. So certainly has come down from where it had been, right? We know that at one point mortgage rates were well over 7%, 7.5%. Now, we've talked about in some of our teachings, the rate of equilibrium for mortgage rates is somewhere around 5.5%. So we're still a good ways away from that. We get a lot of questions from investors that we work with at Wealthbuilders on, what's going to happen with rates? How can I get, if they're buying for personal use, how can I get the most affordability? And then if they're buying for their investment portfolio, what are rates going to do? Because obviously your cash flow is dictated by a lot of things as an investor. And one of them is the cost of debt, right? The cost to put leverage on a property. So in many senses, the real estate market, just to give you an application here, the real estate market has been a bit frozen, as it were. Supply has been growing, creating more of a buyer's market, but many of the buyers still have issues with, well, what do they do with their current home if they're selling and going to buy a new personal residence, having to sell or trade in a current mortgage that's at 3%, and then buying a new property and being at close to 6.5% mortgage on that. So it has been a bit of a buyer's market. Of course, real estate is geographic, right? It's local. So there are always opportunities in real estate. People moving, people dying, people unwinding assets. That being said, there's going to need to be a couple more interest rate cuts for us to see mortgage rates continue to come down a little bit more. Our personal opinion here on the Kingdom Finance Show is, as we move into the first quarter of 2026, we will have a couple more interest rate cuts that will already be in play, that will have been executed, and we should see some growing stimulus in the real estate market, particularly demand picking up. I do think, from talking to some real estate friends, demand is going to pick up a little bit here in the last few months of 2025. Rates have come down just a little bit, just enough to give people some hope, or just enough to say, hey, we can make this work to buy something for personal or investment use on that. And a lot of people are wanting to get something done with real estate before the end of the year for multiple reasons. One of them for investors being tax purposes. There's a lot of tax benefits, particularly with the new big beautiful bill, which we talk about on a different episode of why it might make a lot of sense to put some tax planning in place before the end of the year. Now, while I'm on that topic, although it's not the whole point of this week's show, there are several advantages, tax advantages on the table between now and end of the year. There is what's called the accelerated depreciation law, which has been made permanent by the big beautiful bill. Now, that affects real estate investing if you want to accelerate your depreciation write-offs. There's also benefits to that for solar panels, for electric vehicles, different tax credits and tax write-offs, and also for small business owners in general who are wanting to put equipment, machinery in place for their businesses. There is accelerated depreciation write-offs for that are now back to the 100% level. So many astute business owners, if they have a specific need for machinery or equipment that qualifies, that they can go ahead and put in place for their company, and then they get a write-off and a credit for that on this year's taxes. So just want to make a point on that there is tax planning to be had, particularly for business owners and real estate investors as we move into the end of 2025. Now, interest rates coming down help that a little bit. Most of that, we'll see a lot of activity as we move into 2026. Now, this 10-year bond, just to go back to that, it did go down to 4.0% when the Fed announced rates were being cut. And however, it's actually come back up to, when we recorded this, about 4.15%. Now, that may be way too technical, and you're saying, Chad, this is boring. What does it mean? What it means is that the bond market, again, it's a future-looking indicator. So that's an important point. What the bond market is saying is, hey, it went back up a little bit because there's still some underpinning issues with the economy. What is the health of the economy? What's the status of jobs market? How weak is the jobs market? What's the status with inflation? How much, we talked just a few minutes ago that inflation is still going up. So the bond market is saying, hey, how big of a deal is the jobs market going to be for the economy? How significant will inflation increases be? So the bond yields on this 10-year bond, they're not just going to drop straight down below 10% overnight. And then, of course, there's also the ongoing issue of just the U.S. deficit. How much new debt will the U.S. government have to issue in order to pay the interest on the current deficits on that? So that's an interesting point, because intuitively you would think that bond yields are going to go down and stay down, but they went down and then kind of come back up. Now, again, mortgage rates are not directly correlated to that, but I just wanted to make that point. The health of the economy still has some specific things to be looking at. Well, let's talk a little bit about the market and what capital assets we believe, again, not here to give specific advice, but give you some ideas on what institutional investors are doing. Now, when we're in a stagflation environment, some analysts, think tanks will call this the quad three. Quad three just means growth is decreasing rate of change and inflation is increasing rate of change. There are particular assets that are going to be more bullish. They're going to have a little bit more wind at their back. For that, some of those will include things like the equity markets, the stock market, certainly technology stocks, the NASDAQ, companies like NVIDIA and others that are in technology, big tech, small tech. A lot of those are going to continue to see meaningful concentration from institutional investors, but also things, gold is up some 40%. So hard assets like gold and silver continue to be a good place for institutional investors and retail investors to have an allocation to it, because it is a really good hedge against the dollar and a good store of value. Again, gold being up, 40%. This year. That's always a good allocation piece on that. Gold and silver being where they are in prices, even mining companies. So public companies that what they do is they go mine for gold, right, to produce that gold. That's another bullish place to be in a portfolio based on where we are with the economy, with interest rates on that. Historically, when interest rates go down, you will see small cap stocks do better, because small cap companies are more dependent on rates for lines of credit, for growth. They need more access to capital. So as access to capital, cost of that access to capital cheapens, it allows small cap companies to proliferate. So that's something to look at. You look at things like the Russell 2000 and some of the small cap indexes. There's the potential for those to do well also. Crypto and digital assets certainly have become more mainstream in the last couple of years, and the current rate environment certainly makes more of a bullish case for having a allocation, although you want to temper it with your suitability and risk tolerance in some of those bigger cryptocurrencies like Bitcoin and Ethereum. You're seeing a lot of institutions put allocations to those. So those look favorable as well. And so you've got kind of a conglomerate of some things here that are working, particularly given this environment on that. Overall, the major takeaway here is that this is the first of 3 interest rate cuts that have happened in September. We expect 2 more identical rate cuts in October and December, and that's gonna make some alignment issues for real estate come into play that we've been waiting on. But we do see very favorable environment for some of these equity asset classes, as well as some of these more commodities, the crypto and the gold and the silver, over the next several months. Now, as we move into 2026, there'll be some changes in the economy that we think will happen. But for now, over the near term, these are some of the positive indicators of where to be, what we call asset allocated how you diversify your dollars, whether this is you're running investments for a ministry or a business or for your own family and retirement on that. So this is somewhat of an expanding bull market in what we call a stagflation environment. So there are meaningful opportunities out there. And again, I've mentioned, highlighted at a high level, some of those that you can look into. If you want to get specific investment advice, again, I cannot provide that to you on the show, but we do have a wealth management firm called Wealthbuilders Investments. We do have a team of advisors that are registered and happy to work with you to evaluate your overall investment strategy. And we've got a lot of free resources. So if you want to learn more about great, Chad, some of this week's show was a little bit over my head or a little technical. If you want to know, hey, okay, how do I rebalance, position my portfolio as we move into the end of 2025, we'd love to connect you with our team. Best way to connect with us, we'll put this in the show notes, but you can go to wealthbuilders.net/invest. wealthbuilders.net/invest. And you can get a free resource and also just set up a consultation with our team, complimentary consult. And we'll be happy to talk through specific applications of some of these asset classes that I've mentioned on today's show, just this general stagflation environment and what it means for the markets. So again, I hope this has been helpful. Again, I realize some of these shows that we do are a little bit more technical in nature, but overall, the environment is positive for a lot of asset classes right now. We mentioned some of those, and there's going to be growing opportunities in real estate as mortgage rates move closer to 6%, but we're not quite there yet. So again, a lot of people will be talking about the headlines of, oh, great, interest rates were cut. But again, we think, the Fed has somewhat missed the timing of this, as we talked about on the previous show. But hey, a rate cut is better than no rate cut. That's going to help free up some dollars for spending and investing. And as investors, the key thing here is just to look for clarity out of the noise. And again, we don't want to make super rash short-term decisions, but we want to be mindful of, hey, there may be some things you want to do to position, or should I say reposition your investment portfolio between now and the end of 2025. So that's going to wrap it up for this week's show. I've got some more stats, but I feel like I've probably hammered home some of the major topics on that. Again, this is going to be a continued theme in October and December. We'll most likely see 2 more rate cuts. Again, there's a lot of tax planning that's going to start happening here in the fourth quarter. We'll probably do a whole separate show on that because we can dig deep into some of the tax planning that we're doing with certain families and business owners that are looking to put money to work in a tax efficient manner and get that on the books for 2025. So just to wrap up the show, what the Fed did was exactly in line with what we expected. The first of 3 rate cuts. It's certainly positive for the broad stock market. It's positive for hard assets. And it starts to give a breath of fresh air to some of the real estate market that has been somewhat frozen for several months. Well, that's it for today's show. Again, my name's Chad Frantzen. I appreciate you being here on the Kingdom Finance Show. Again, if you want to learn more about how to apply your values to your money, and what we like to say, apply your faith to your finances, we'd love to connect with you here at the show and through Wealthbuilders Investments. And if you just want to apply some of these topics that you've been hearing, please reach out to our team. Wealthbuilders.net is how to find us. Please like and subscribe to the show, and we will see you next time on the Kingdom Finance Show.
Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.